When I think about bubbles, I think about valuations detaching from fundamental reality. So when I look at real yields and our expectation of no growth and very low inflation for the next couple of years, I don't see a bubble in bonds. I see ranges forming in government bonds that are in touch with the reality of the market.
Emerging market debt's had a fantastic year this year, but yields have come down to historic lows. But we think that's still fairly valued, because what we're seeing here is a relative value decision. And what that yield is reflecting, and the reason why it's come down somewhat, is the fact it's reflecting the good, strong fundamentals that are underpinning the emerging market countries themselves. And that will continue. When you look at emerging market corporates, again, they're trading around 325 over. They've still got a lot of value there. When you look at them compared to corporates in the US market, so Lisa's market, for example, a BBB comparison between the US and emerging market debt, emerging markets still trading about 100, 104 basis points over.
Yeah, I mean, I still think there is more room to go. If we get a degree of stabilization in rates, Bob's scenario, as he's pointed out, where rates remain low for an extended period of time, corporate bond spreads, whether they be investment grade or high yield, should compress. The other thing to bear in mind is that the fundamentals support that. When we look at what investment grade companies have done over the past 12 to 18 months, they have done everything to shore up their balance sheet. They're holding record amounts of cash, and they're very reluctant to spend that cash. We can make the same comparison for high yield. If you look at any metric, whether it's revenues, cash flow, or leverage, we're seeing positive signs in each of those areas as well.
I bet if you're at the Fed today and you're sitting there and you've just chucked $600 billion at the market, your central forecast wouldn't have been for interest rates to rise about 50 basis points right out of the gate. So I think it's debatable how good these policy tools actually work, and whether they'll work over time. By definition, they're unconventional. We've never done them before, so we don't really know the impact. And you look at the commentary coming out of the Fed, and it's split. Ultimately, the Fed had little choice but to create another quantitative ease program. Currency revaluation and asset price revaluation does work, and I suppose if you go back to the original question and you listen to what the Fed is telling you, they're saying they're trying to create asset appreciation. Yep. That's what they're trying to do, reflate asset prices. And the first thing to do is to create a cheaper currency, and the next thing to do is to push people out of cash and government bonds.
Well, and there's one area that does certainly need capital, and that's Europe. And we couldn't get away today without discussing the situation in Europe and some serious difficulties here. So what about Europe? Can the peripheral countries survive without a restructuring of debt in the government bond markets and the banking sector?
When you think about what's going on with the peripheral countries, I think there's a realization that a restructuring has to occur down the road, that the level of debt is too great. Nobody has the ability to pay back their debt today, whether it's Germany or the US or Spain or Ireland. Everybody operates on the assumption that you're a sovereign, you'll be able to roll it. And when that confidence isn't there, you're unable to roll it. And the problem with confidence is the banking system is seen to be a contingent liability to sovereigns, or the 4% deposits that the Spanish banks are paying. And when I look at that and I think about how we buy debt, we always assume that the senior note holder in a way is pari passu with the depositor. And I don't feel that any longer. I feel that the depositor is the voter, and the senior note holder is a nebulous institution that governments don't care about and want to regulate and take money from. So, you know, as cajas and banks pay these very high deposit rates and they bring in depositors, they're growing, I believe, a class of holder above the senior note holder. And I don't know how that gets reconciled.
You look at the fundamentals of emerging markets, they are so much stronger, both in terms of government debt and also the fiscal position than developed markets. They just don't have these entrenched problems that we see in developed markets.
As we talked, you talked about lack of familiarity. Well, Lisa, can you comment on that with regard to corporates? Because emerging market corporates are almost by stealth becoming a bigger and bigger part of your investment grade index,
Exactly.
and then there's the high yield sector too. Can you expand on that a bit?
Sure. You know, when you think about emerging market corporates, you think about something that's very exotic and not necessarily mainstream. And yet, when I think about the types of names that we invest in that are part of our global investment grade corporate bond index, you have some of our biggest positions have been in names like América Móvil, a large Latin American communications company. You've got Vale, the Brazilian-based mining company, which is one of the largest mining companies in the world. ArcelorMittal. Again, you know, technically an emerging market credit. So emerging markets are fast becoming mainstream. But when we think about credit metrics for these companies, compare developed to developing, lower leverage, and they're actually behaving in a very bondholder-friendly fashion as they raise funds. So I don't know, to me, I think it's a great proposition.
Yeah, definitely. And I think it's actually more difficult for an emerging market corporate to get the same level
Right.
of rating from the rating agencies as compared to a developed market country.
Yeah.
So what should we be worried about, Bob? What are the main risks that you see?
Well, I mean, you know, in a way, you are describing the ideal time to be a bond investor. In a way, I've waited my whole life for this. I mean, no growth, no inflation, you know, and it's like, great. When you look at this whole fine balance of deleveraging, policy intervention, and investment, and you know, just the thought that that can last for many years as long as there's a patience, I think there are two main risks to that, and they're both policy error risks. And I think the first one is at the official institution level, where the tension between developed markets and emerging markets is very, very high now. The second big risk to me is again, a policy error, is political. Politicians, by definition, have to be reelected. And guess what? When you're in recession and unemployment is 19.8% or 9.7%, you don't get reelected. So you try to find a shortcut. Well, I think given everything that's going on globally, you have to think very flexibly about how you invest. And I want to put it in borrowers who I think are funding at too high a rate and can pay me back. And I think, you know, I would split it in a diversified corporate bond fund.
So it's a separation of the interest rate exposure and the currency exposure that's
Yeah, and I
critical
think you need
strategy.
to, you know, to be, you know, find a manager or fund that can flexibly do that, because those opportunities will shift as valuations change, because we're not the only ones in this room who are going to figure that out, and at some time, you know, that valuation shift will occur.
I would say on the investment grade side, I like being invested in the bank sector, but you've got to be willing to trade that actively. As well, within our global funds, we try and take advantage of the emerging markets theme. So you'll see many of our companies really are those that have broad exposure to developing markets. The other thing that we've done within our funds is we have maxed out our high yield exposure, because I share obviously the same view as Bob on that. In our global corporate bond fund, we have a 10% cap. We've been very active in utilizing that allocation specifically into the BB sector, which to our mind still looks very, very attractive.
So you need to be tactical. You need to look out for those differentiated opportunities that we still see. On the local side, as Bob was saying, we completely split up the rates decision and the FX decision. Rates has been the key driver of returns so far this year. It's been a fantastic to be able to take advantage of that in terms of the active space. But where we think the advantage is going to take over in terms of going through next year, currencies should be the major driver.